You're constantly buying high and selling low, aren't you? It's because you're missing the market's true direction, hidden in plain sight. What if you could see the underlying current that moves prices, the same way professional traders do? Today, you will learn how. Every price move tells a story, but raw data is noisy. Moving averages are your market translator, smoothing out the chaos. A moving average, or MA, simply calculates the average price of an asset over a specific period. It's a dynamic trend filter. The simple moving average, or SMA, gives equal weight to each price in its calculation. It's straightforward but can be slow. The exponential moving average, or EMA, prioritizes recent prices, making it react faster to new market information. For active trading, EMAs are often preferred due to their responsiveness. SMAs are better for longer-term, broader trend analysis. When the moving average line slopes upwards, it signals a clear uptrend. Price is consistently closing above the average. Conversely, a downward-sloping moving average indicates a downtrend. Price is generally closing below the average. A flat or horizontal moving average suggests a sideways or consolidating market. Here, MAs offer less clear signals. One of the most powerful signals is a moving average crossover, where a shorter-term MA crosses a longer-term one. The golden cross occurs when a shorter MA crosses above a longer MA, like the 50-day over the 200-day. This is bullish. The death cross is the opposite, a shorter MA crossing below a longer MA. This often presages a significant downtrend. While powerful, crossovers are lagging indicators. They confirm a trend change after it's already begun, not predicted. Moving averages can also act as dynamic support and resistance levels. Price often bounces off them during trends. In an uptrend, the MA can serve as a floor where buyers step in, pushing the price back up. This is dynamic support. In a downtrend, the MA can act as a ceiling where sellers emerge, pushing the price back down. This is dynamic resistance. Many traders use multiple moving averages together to gain a clearer picture across different time frames. A 20-period EMA is popular for short-term trends, reacting quickly to intraday or swing trading movements. A 50-period EMA offers a medium-term perspective, useful for identifying intermediate trends lasting weeks or months. The 200-period EMA or SMA is a widely watched long-term trend indicator, signaling the overall health of an asset. When multiple MAs are stacked and fanning out, it forms a ribbon indicating strong trend momentum. Conversely, when MA lines converge and flatten, it often signals a loss of momentum and potential consolidation or reversal. Remember, moving averages are lagging indicators. They reflect past price action, not predict the future. In choppy, sideways markets, MAs can generate numerous false signals, leading to whipsaws and losing trades. To avoid these whipsaws, always confirm MA signals with other indicators or price action analysis. For instance, a strong MA crossover with high trading volume adds conviction to the signal. Look for bullish candlestick patterns near a rising MA acting as support, or bearish patterns near resistance. Moving averages work across all time frames. A 50-period MA on a 5-minute chart is like a 50-day MA on a daily chart. No indicator is perfect. Always combine moving averages with sound risk management and position sizing. Moving averages are a tool, not a crystal ball. They enhance your understanding, but don't guarantee profits. Practice identifying trends, crossovers, and dynamic support/resistance using moving averages on historical charts. Mastering moving averages gives you a powerful lens to see the market's true direction, just like the pros do.